The trade war has hit equities harder than the U.S. and Chinese economies, although the Chinese economy is hurting a little more than the U.S. The reason equities take most of the pain is because some of the tariffs and costs associated with supply chain disruption, they get absorbed by the reduced profit margins, such as the impact on the U.S. economy is going to be limited to slowing economic growth, but a recession is not likely. Now first, the reason companies are willing to absorb most of the costs of tariffs and the supply chain disruption is because we're in the internet era of price transparency. Price transparency makes it easy for consumers to comparison shop, which they do aggressively. Companies have lost pricing power, so companies now focus on maintaining market share and profit margins. Raising prices would virtually guarantee a loss of market share. So profit margins take the hit, and equity valuations are seriously impacted by any escalation of the trade war. By contrast, when we think of the economy, the main driver of U.S. GDP is consumer spending. And consumers are likely to continue to spend so long as they have a job and are confident of keeping that job. So far, there has been little to no impact on the U.S. labor market from the trade war. Companies are maintaining production, they're keeping the jobs, and they want to keep their market share. The unemployment rate remains comfortably below 4%, and spending is robust. What impact there has been on U.S. real GDP has come from declining business investment. Companies' long-run business investment plans have been delayed and in some cases indefinitely postponed. This can be clearly seen in the investment category of real GDP. This category is relatively small in its total impact on GDP. So the U.S. economy has decelerated, but again, a recession is unlikely. Now, China is a somewhat different story because its economy is much more dependent on exports than the U.S. economy. Chinese exports to the U.S. have dropped. However, China has been able to increase its non-U.S. exports. The result has been flat overall exports, no export growth, but avoiding a sharp decline too. I'm Blue Putnam, Chief Economist, CME Group.